undisputed trader. Here is a quick one. I want to talk about demand and supply. I know you must have heard about it, and if you have not heard about it or learnt about it as a beginner, you are still welcome. You have something to learn from this concept. This concept is a very outstanding concept in the trading community. Whether you are trading crypto, whether you are trading forex, whether you are trading the stock market, it is still the same thing. It works literally everywhere. So without further ado, let me go straight to the definition before I explain it to you. You understand? So this is the definition that we have on the demand and supply. So what is actually a demand zone? You understand? A demand zone is actually, sorry, a demand zone A demand zone is an area on the chart where buying interest is strong enough to overcome selling pressure. When price enter this zone, it is often expected to rise. You understand? Price react upward from this zone, seen as the support. The supply zone. What is the supply zone? Supply zone is the direct opposite of the demand. The supply zone is an area where there is a selling pressure, and when price return to this zone, price is expected to fall rapidly. You understand? So what are the things that you should put into consideration before you mark your supply or demand zone? Okay, to mark our demand or supply zone, you want to first of all look at the direction of the market. That is the number one thing that you should do. Is the market in a ranging market? If the market is in a ranging market, that means that market is moving within a jurisdiction. You understand? It is moving back and forth within a range. So you can still find demand and supply in a range. You understand? Then is the market trending? Is it trending to the downside, breaking structure to the downside, so that you can find your supply? You understand? In that scenario, you have to find your supply so that the moment the price return to this supply zone, you are to sell the market. You understand? And if it is going to the upside, trending to the upside, you are to look for demand. So the bottom line is to, first of all, before you mark anything on your chart, first of all, know the direction of the market. Try to decipher the direction of the market. So this will help you to know. Just have to know the order flow in the market. So you have to know the order flow in the market. So once you know the order flow in the market, you can know the possible place that there will be demand or supply. You understand? So this is how to do this thing. Then the number two thing that you need to mark, you need to take consideration, is to know where there is a large movement of candle, where there is an impulsive candle. Where is those places on your chart that you can see impulsive candle moving rapidly from? So you have to take consideration of those sharp movement in the market. Then what actually give the things that happen before that movement, that sharp candlestick happen? You understand? What are the candlestick that you can find before the movement? So you have to mark the last candle or the cluster of indecision candle that led to the rally. Then number four thing that you need to consider is the imbalance, the fair value gap. So we know these places that the market move rapidly from, the market move along with a fair value gap behind. You understand? So this fair value gap shows you that there is a strength on that zone, and the moment price return to that zone again, it will likely sell or buy. You understand? As the case may be. So what exactly is a supply zone? You understand? This is how it will look like on your chart. You understand? So this is how a typical supply zone, you will see a range, a little range before the massive movement to the upside. You understand? So the idea is that once the price return to this zone again, the price should buy aggressively to the upside, you understand. So it is still the same concept for the supply zone. So when the price return to the supply zone again, it is expected that it will sell aggressively to the downside. So, and these are the type of candle that you should keep into consideration when marking your order block. This type of candle, this type of indecision candle actually form the base of the market, you understand. It could be inverted hammer, or it could be a rejection candle, or or a hammer itself, or it could be a spinning top candle with longer wick to the up and longer wick to the downside with just a little body. So these are the type of the candle that you see that will form the base of the rapid movement to the upside, you understand. So these are the things that you should keep into consideration when marking your demand and supply zone. So okay, now the ideal way of marking the demand zone on your chart, you understand. So this is a typical example of how the chart works, you understand. So first of all, as I said, you have to know the direction of the market. Once you know the direction of the market, they have to look for the rapid movement of price from that zone, you understand. And in this ideal scenario, we have everything uh, you have everything analyzed here, you understand. Okay, see, this is the rapid movement to the upside, you understand, followed by followed by an inefficiency or fair value gap, you understand, fair value gap. So this is the fair value gap, you understand. So now what you have to do now, since you know that a rapid movement move from this zone, you have to mark the base, and the base is the last candle that forms before the rapid movement started happening, you understand. So other people like to mark the first candle among the sharp movement to the upside, which is fine. But if you want to be on the safer side, just mark the whole range. There's nothing bad in marking the whole range. So the idea is that when price return to the range, it could return to this range of the first candle, or the bearish candle, or the bearish candle that push the market to the upside, the last bearish candle, and go up. It could still return to the first candle and still go up. It is still fine. They are just marked everything together. Once the price return to any of this zone, what you have to do is to wait for your confirmation candle. It could be a spinning top candle, it could be a hammer to the upside, showing that okay, price now wants to go to the upside. So in the moment the candle close, you want to look for the next opening and continue buying to the upside, continue buying to the upside to take out the nearest liquidity above, you understand. You should target your nearest liquidity above when you are buying the market, you understand. That is the ideal thing to do, you understand. So guys, this is what I have for you. This is just a brief tutorial, and if you want more in-depth one-on-one tutorial to grab this concept, you can reach out to me on my Telegram channel. Thank you. I'm looking out to see you there. Thank you.